that you got all stakeholder support, which is a big challenge for most people. So how did you manage to do that? And let's start from there, you know.
Before I do that, I think I will share the concerns of most of people here who did not put up their hands when you asked for volunteers to take up the position in 2008. So I also went through the same apprehensions, you know, and coming from a multinational bank, you had all those apprehensions, and market perceptions were pretty negative. So I can only say that it took us 9 months to take that decision. And in those 9 months, a lot of the strategic elements came into play. I will come to that lately. Sure. But to answer your question on how did you get the stakeholders together, so who were the stakeholders at that stage, right? So the first was the regulator, right? Because the regulator was in a situation that they were about to impose, they call the prompt corrective action on the bank, PCA. And you know, the prompt corrective action happens when your ROA falls to below 25 basis points. So they were on the verge of doing that. So the first point of call for me was the regulator, right? And I got inspiration from what I was told by a senior RBI deputy governor. And he said, Mr. Sobti, you've got 2 problems. This was before I joined, right? So before I took the decision to join. He said, Mr. Sobti, you've got 2 problems. One, your bank is considered an outlier. This is the first time that I learned the definition of outlier. I didn't know there was such a thing like an outlier. So I queried him and said, what is an outlier? Outlier means you have very poor earnings quality and you have very poor loan book. And we are about to initiate prompt corrective action. You know, prompt corrective action, I don't know how many of you knew that, is that they will stop you lending. There are massive restrictions imposed on the way you can grow. They will put observers on the board and all those sort of things. And the second one he said is that you've got an identity crisis. You're not sure whether you are a bank or an NBFC. Because Ashok Leyland Finance had merged with the bank in 2005. In effect, what they were saying is that the merger has not happened. So the first point of call for me is to sort of do that sort of reassurance with the regulators that we will come out with a cogent plan and we will share that plan with you. Plus, I think there was a little bit of supportive stance from RBI at that stage, because they had seen what ABN AMRO had done in terms of compliance and profitability and things like that. So there was a little bit of credibility at that sort of stage. The second was, the shareholders. And the biggest category of shareholders was what? The promoters, right? And the market perception that we also shared when we came in was that the promoters interfere with the bank. And there is no autonomy, that sort of thing. So, when I sat down for the first time and it's not about salaries and bonuses and ESOPs and things like that. It was all about governance, right? It was about governance saying, if we come in, what's your role? And in one meeting, I remember that all 5 of us were there and I said, this is the way we think the bank should work. You tell us whether you can work like that. You are promoters, therefore you are shareholders. You are one category of stakeholders. There are other shareholders as well. But because you are majority shareholders, you have one right which others don't have, which is to appoint board members. Therefore, you can only come in through the board. That's your role.
And they accepted that.
Well, they did. And I can tell you that they have stuck by it, right? And they said that, so you have the stakeholder at the shareholder level, then you come to the board, right? And we said the board is a statutory board. It's not a managing board. Let's be clear. The board doesn't manage. Executive management manages. You're a statutory board. We will fall in line with every element of governance that you will ask for. The job is governance and statutory governance. The RBI has imposed those governance and we follow it. Don't try to manage. Whom to fire, which branch to open, how much to invest in technology, right? Where to go to, executive management. We'll bring everything to you. And of course, you have the right to say no. But we will initiate strategy. We will initiate the execution plan. That's the role. So we clearly laid down the role of the shareholder, the board, and executive management. So the buy-in from the regulator, I think was a consequence of the fact that we had some goodwill as a consequence of the previous performance and that sort of thing. The buy-in from the shareholders was this: we will look after the interest of the shareholders. You are one of the shareholders, right? But you will not be privy to anything that the bank does. And even today I can tell you, the shareholders, which is the promoters, learn about the bank by reading newspapers, right? They see the results the day the rest of the world sees the results. And they are very happy doing that. They don't want to interfere. One of the brothers actually told me, saying that, look, Romesh, we are traders. We are not bankers, right? You guys run the bank, but look after our interest. Don't run it down. As a lot of managements have come and gone, don't run it down, as I was saying. So I think then other stakeholders are investors.
Yes.
And that is the toughest part. And that could not happen upfront. There was no credibility at all. And that was one of our biggest challenges, was to bring capital. You know, if you work on strategy and all, the biggest challenge was, how do I bring capital in? Recapitalizing the bank, we were perilously low, close to being breaching the CRA requirements, right? Now you can't go around to investors who have seen your performance over the last, say, 12 or 13 years and say, give me capital just because I come from a foreign bank, right? They don't come that way, right? They only come through track records. So there's a lead lag between investors putting in money, and that lead lag is linked to the way you perform. So I think that was the process of buy-in. The major buy-in was regulator, because there was another issue which we did not learn about in our due diligence. And that was the issue between the promoters and the Reserve Bank of India. And that was that, you know, when the bank was licensed, the license condition said that the promoter's stake will not fall below 40%, mandatorily. And then, of course, there was a change in thinking when Dr. Reddy was there, and RBI then came up with the proposition that no entity will own more than 10%. Correct. And when they introduced that, the promoters said, well, your license says 40%. I'm not going to reduce. So there was a big face-off between RBI, and we were not aware of this.
Until you actually came on board.
The due diligence we did, we overlooked this part. And that's why we found that in the first week, I found that there were about 20 approvals pending with RBI for 2 years. So that was a face-off that was the thing. So it was very, very important to get the buy-in of the regulator.
The other major stakeholder is, of course, the employees. You know, you were coming from outside the bank. You were new to the bank, and it was an existing running institution with a set of people with their own ideas of what is right and what is wrong, and you needed them to run your strategy. So how did you deal with that?
Yeah, I think that one of our big challenges was credibility. So, you know, 5 guys come in from a foreign bank. They drive exotic cars. They come to office in a Mercedes, right? They wear nice clothes. How do you relate to the fact that the average salary in the bank was, say, 1/20th of what they thought you were getting? So it was a huge issue of credibility within the bank. And I think we took some steps. So first step was that we took salary cuts. And we let the people know that we have taken salary cuts. We took huge bonus cuts. And we communicated that we have taken bonus cuts. Consciously, we demonstrated frugality. Nobody traveled business class for the first 3 years. Nobody, including the managing director. The managing director did travel business class, but he paid the difference. So everybody knew in the organization that that's so. So I think that was a phase where you were trying to build credibility, that there are not people who have come from Mars to sort of settle this whole thing. The other element was communication. Right. So on the 28th of March 2008, we presented to the board our strategy. And in the first week of April, we were out in the field. 180 branch managers. Over a period of 3 days, every branch manager was met in town halls, right? The whole idea was for them to see us and to sort of be assured that we also are made of blood and flesh. And there was nothing different about us. That we had come here to create, to restore respect to the bank. And we presented our plan to them. Right? At every one of these town halls, we spent 3 hours, 4 hours with our plans. And we also shared with them their plans. So we gave them in the first week of April, we gave them their yearly plans, all 180 branch managers. And we told them how to achieve them, how we will help them achieve it. I think that buy-in was very, very critical. And it was all predicated on communication. Communication, communication, communication. Every forum that you get, communicate. Stand in front of people. We call them town halls, right? Just go and stand, get the branch together, and tell them what we are doing. And we enunciated a philosophy that as the managing director, I want the executive director and the teller to know as much as I do. That was the communication philosophy, that you should know as much as I do, so that you relate your work to the strategy that we are building. So there's little credibility out of that. And I think it didn't take too much long. And I think there was an inherent desire in the 2,800 people that were there to turn the bank around. Right? So on one side there was skepticism about these foreign banks, the other side was the desire that, oh, look, I mean, we have no respect in the market. And if somebody is coming to sort of change things around, then we should give them a chance. So I think it was all predicated on effective communication and, of course, the clear-headed strategy. That the strategy should be understood by the people who are going to implement it.
So when you talk of communication, and I think you've emphasized it correctly, that's important, but there's also, is there a need to encourage two-way communication? Because there's one-way communication that almost all of us are very familiar with doing, that I have decided this and now I'm going to tell you what I have decided, versus actually engaging and involving and getting them the sense that, well, if I have a point of dissent, I'm free to talk about it.
You know, there's a theoretical element to it, this two-way communication. We hope it happens that way. But I can tell you, even now, after 8 years, if I get 200 people together and say, okay, open forum, ask questions, it takes a lot of courage to ask the first question. Then things open up. So, of course, we have encouraged two-way communication. So we said, okay, we'll give you other platforms to communicate. You don't want to stand in front of the managing director and say, ask a silly question. You think it's a silly question. We don't think any question is silly. But you in your mind think, oh, it's a silly question, what will they think about us? I said, all right, here's a platform for you to directly send mails to me, right? It was called Listening Post, right? And I was flooded. So we set up these platforms. There's a Listening Post that you can send me a mail which nobody else will see. Nobody else will see that. And if there's an actionable, then I have a way of getting it actioned. There's another this thing which came later, my idea platform and things like that, which is standard. You know, a lot of organizations do that. So we have always encouraged this thing. And you know, if you're standing there as the managing director and you are there as they say the chief manager, you think twice before asking a question, right? Only once you on a one-on-one basis you will do that. But in front of 200 people.
Forum, you're not sure how it will be taken, what will be the repercussion of it.
But the top 50, they will fight you to death. They will fight you to death. That sort of thing, because the top 50 know what you were made of. A lot of people have worked together, you know. So if you see the first 5 who came in, the first wave that came in, the next 30 also came in from people that we knew. They're not necessarily ABN AMRO Bank, but somebody from ABN AMRO has gone to Stand Chart and he comes here. So there was, I think, this huge like-mindedness, which was very critical in any sort of a turnaround story. And somebody had mentioned that he had the advantage of a team. Right. And you were right. I mean, we had 5 of us. So we said, all right, you handle the consumer bank, yours is the corporate bank, you will do the risk part, and you will handle IT, technology, finance, everything. And there was simultaneous penetration into all the areas. And, you know, coming alone, it never works. But what is critical is like-mindedness. 1. 2, there has to be a common compelling objective. That is a team.
That binds the team together.
So it was not 4 people reporting to the CEO that makes a team. It's a bunch of people who have a common compelling objective. and they have interdependencies to achieve it. I think that's what we had. We were fortunate to have that.
So when you looked at the situation, obviously you must have been brimming with ideas that I would like to do this, I would like to do this, and let's do this, let's do that. What were the constraints that you faced? Did you have to drop doing something? Did you have to stop yourself from doing something that you would have liked to do?
Oh yeah, the list was pretty long. I can tell you that technology is very close to my heart, and I believe that technology makes a difference, finding customers, serving customers, engaging customers. I would have liked to do a huge technology refresh in the bank. We couldn't afford it. So we had a core banking system called MySys. It was a British system with very few banks. I think we were the only bank in the country using MySys. I would have liked to refresh that way back in 2008, 2009. But the cost really deterred us. I couldn't do that. So actually we introduced Finacle in 2012, 4 years down the road. So we staged it. So the compulsion was you didn't have the money, therefore you had to do a staging. But you had to have a customer front end. So whatever little money that we could raise, we put into the customer facing this thing, not the core banking system. Right? So that is one element that we deferred and did it much later. There were other areas of business, which I have a personal belief in, one is microfinance, financial inclusion. And that belief in that sort of business came when I worked in State Bank of India in Bihar, right? That how much difference it makes to local economies and local ecologies. And it's a viable business model. We did it in ABN AMRO. We were the only foreign bank which had 1 million rural women financed by a foreign bank. So there was a belief, management belief, that this is good business. We didn't have the reach. We didn't have the reach to do this sort of business, right? And that sort of thing. We didn't have the credibility to find good partners at that stage. So we had to defer. So I think there was a staging. The other one is somebody mentioned, the footprint expansion.
Yes, the branch expansion.
Let me share a fact with you. For the first 2 years, we did not open a single branch. 2 years, no branch. We said 180 branches, fix them first. So we came from a bank which had 33 branches, ABN AMRO Bank, and was reckoned as amongst the best distributors of third-party products. And we said, if 33 can do that, how much can 180 do? So let's fix that piece first. So not a single branch was opened. If I had the money and the capital, maybe I would have built up a better footprint upfront, right? But you're always worried about what are the big risks is the cost-income ratio. And about the time that we were setting out on the journey, there was another bank which had also set out a journey. I will not name the bank, but you'll figure it out very quickly, who put the money up front. So this is the philosophy of, should I invest to grow or should I first grow and then invest? That bank chose invest to grow. The cost to income ratio went to 93%. The CEO lost his job.
Yes.
Right? This is what happens. So you've got to stage this whole thing. We said, look, first get the money, then we'll do the investments. Let's fix these 180 branches. 180 branches was, for a foreign banker, 180 branches is like, like a child in a toy shop. That's the sort of opportunity and advantage that you have, 180 branches. So that's the other staging that we did. So there were conscious choices taken. There were some product choices also that we did. For instance, today we say that, what about investment banking? Right? And I still remember that the first presentation that we made it was an informal presentation to the board and the promoters. One of them said, where is investment banking? So we said, hello, you're talking to the wrong people. We are commercial bankers. But very soon we realized, and the realization happened in the Lehman crisis. Right? The Lehman crisis came 6 months after management change. And it was the biggest learning that we ever got. And it was the most, profitable sort of part of the journey that we had in the Lehman crisis. It did wonders for us. It taught us liquidity management, that don't create mismatches. That was the biggest lesson that we had. And after that, we've gone through 3 liquidity cycles and our margins have not moved. 15, 20 basis points, I think that is the thing. So that staging is very, very critical. So you stage your process. So investment banking, right? And when the books stopped growing, then we said, hello, if we had done investment banking, then you do syndications and throw out the book into the market, and you make money, fee. And that's why that was a course correction for us in that sense. Otherwise I would have started investment banking upfront. We deferred it, but the crisis brought home the fact that there's an alternative source of money. So there were many such things that we deferred consciously. Product choices we deferred. Credit cards. Right, credit cards we didn't do.
It later, yeah.
We didn't do credit cards. We said we don't want to do credit cards. I mean, credit cards means 3 years you don't make any money. And then we saw that, one of the biggest advantages of credit card is branding. If you carry my plastic in your wallet, you carry my brand all the time. And therefore, it is important. Even if it's not such a big profitable business, it is profitable for us after we bought the Deutsche Bank businesses. It's a great brand creator.
Brand recall.
Great brand creator. I want my plastic in my customer's wallet. That sort of thing. So these corrections happened. There were some learnings.
So there was a point raised about monitoring and tracking, when you set yourself up, and then you see because there are a lot of external environment changes that keep happening. So many of the things that you thought you might be able to do, you may not be able to do. Competition is putting more pressure. So give us some of those kind of examples of what kind of challenges you faced, not mainly from your own strategy, but because of the external environment change that you saw as you went along.
Yeah, I mean, that point was raised about reviews and tracking and things like that. So I think that coming from a foreign bank, one of the biggest support items that we have is MIS. MIS is critical to the running of businesses. I want MISs daily, weekly, fortnightly, monthly, quarterly, half yearly. Half my business is daily cash generation. The retail business, they daily run cash flows. I cannot afford to wait even a week. If the consumer bank loses steam in the first week of the month is gone. You can't recover. So you must have MIS. That is one of the biggest.
The right frequency.
Yeah. So those
no
reviews,
point in getting it after 3 months.
Absolutely. I mean, so today, it's taken us a while. And I reckon that was one of our weaknesses. One part of the bank created beautiful MIS, the consumer bank. The other part of the bank did not. And they're creating now. Over the last 8 months or 12 months, they've created that. The consumer bank knows what a particular RM in a branch in a state did yesterday in terms of sales. How much FX he made, how much insurance he sold, how much mutual fund he sold, how much credit cards he originated every day. And I can go in from here into the zone, into the region, into the branch, into the RM. I don't do that. It's too micro. But the consumer banking head and the zonal head and the regional head, fantastic MIS. The other part did not. That's one of the weaknesses that I was spot. The other bank. Today, of course, the corporate bank also knows what the account manager has made, that sort of thing. But does the account manager for Escorts Limited in Delhi know how much overdraft utilization happened yesterday? Right? And then does he give a call to the CFO or the thing saying, hello, why are you not utilizing me? That's the sort of, I think the review is critical. As you rightly said, what do you want to achieve, you've got to measure. And therefore, critical, granular MIS is key to decision making. And you can make the corrections that you want, right? So you find after a week or 10 days that mutual fund sales are lagging, right? Which other button will you press? Health insurance, life insurance, origination, what will you do? That sort of thing. It doesn't happen at my level. Yeah. It certainly happens at the level of the consumer banking head and his vertical heads and things like that. So I think reviews are critical. As I said, daily, weekly, that sort of thing. So the frequency of reviews is humongous in the bank. It's always review. I mean, the consumer bank every Tuesday has a review. right, where all the regional heads are all this thing, and they review what happened in the last week, that sort of thing. So it's a critical element of this thing.
Right. So as you look at your strategy going forward, I know there's a huge thrust on digitization, huge thrust on technology, but equally so, the environment is getting more competitive. There's a lot of things happening. So what do you see currently at the big risk in your strategy in the next couple of years? What is it that is keeping you awake?
I'll tell you one element that really keeps me awake is operational risk. You talk of risk categories, credit risk, market risk, liquidity risk are linked. You talk of reputational risk, political risk, regulatory risk, and all. Operational risk worries me the most. This thing. I've grown from 180 to almost 900 branches. I'll go be 1,000 branches by March. It'll be 1,200 branches and 2,000 branches. How do I know who's doing what where? And today the regulatory environment is such, whether it's anti-money laundering or KYC or Cobra Post or whatever things, all those things happen all the while. Operational risk, the risk of fraud, right? The risk of somebody doing a mismanagement on a regulatory front really is something that we are saying. Therefore, surveillance methodologies have to be, you can overspend on surveillance. I think that's operational risk element is one of the things. The other part, of course, which is now sort of the topic of much debate, is this whole digitization part and how it's going to disrupt banking, and how these new players, these payment banks, are saying we will disrupt banks.
Yes.
So I've stood in front of a forum and said, have you ever read the dictionary meaning of disruption? What does disruption means? Disruption means throwing into disorder. And it was never the regulatory intent to throw things into disorder by giving these licenses, right? So there is a lot of dust flying around on this digitization front. And of course, people are doing valuation games. The payment banks are saying, we'll do this, we'll do that. My take is that right now there is a juggling for space. So there are many players, there are banks, there are these new payment banks, there are these aggregators, there are these business correspondents, and there are these small banks. Small banks we can leave aside for a while. All of them are trying to occupy spaces. And these are today valuation spaces. But even if you sort of clear the clutter, you still see that an alternative channel for delivery is appearing. You understand? I will sell my personal loan through my branch, and I will sell it through my website. But I will also sell it through the aggregator, bankbazaar.com. And I will also sell it through my business correspondent.
You'll also have BCs, yeah.
I'm saying complementary channels are appearing. I don't think they're disruptive. They will not shut my branches. Maybe I'll have to reconfigure my branches, and the branch, what I do in the branch will shrink to some extent, right? So my branch sizes will shrink. But these are, I think, they will get embedded in my core. This whole digitization thing will get embedded in my core and complement what I'm doing today. So people talk about in jargon that you have one kitchen, many menus, right? That's the thing I'm saying. That my sales channels will be multiple, and I think so. So there's a huge opportunity. So how do you measure success in this whole area of digitization? A lot of people are doing lots of claims. Banks are also doing some positionings today that my mobile wallet is better than your mobile wallet, and I do so many electronic transactions, you don't do so many electronic transactions. All that is, hygiene. In the sense that I believe that if anybody is predicating a market advantage based on technology, he's lost it. Because technology lags are 3 to 6 months, period. I introduce a mobile wallet today, you will take it off the shelf and introduce it in 3 months' time. There is no this thing.
Correct.
Do you have
the first mover advantage is much shorter time
first
now.
No, I guarantee you there is no first mover advantage. So this is what I call the noise factor out of the thing. But behind this is emerging these alternative channels and if you ignore them, you ignore them at your peril. Internally, we have taken the view that a digital strategy will cause transformation. It's not technology. Technology follows. Technology is not the driver.
What you do with
your
it.
Your digital strategy is the driver. Do you have a digital strategy? Have you articulated your strategy? And have you told the market how you will measure your success? Right? So you say, okay, I will decrease my cost to income ratio by 2% because of digitization. How do I know that you've done it through digitization? Well, let me tell you a measure of success that we have articulated. That the turnaround time of a two-wheeler loan from IndusInd Bank at any dealer around the country for a loan will come down from 4 hours to 2 hours. You can measure it if you want to go and buy a motorcycle. That is the impact of digitization. And digitization has a front-end impact and a back-end impact. The way you do your businesses, you configure your businesses, right? I mean, images will move, paper will not move, so productivity. Ultimately, digitization should give you either increase in revenue or reduction in costs. That is the measure of success.
Or reduction in frauds and losses.
Yeah, surveillance methodology.
Right.